Hello, friends. Greg here. So, we are at the end of another week. I hope you've had a good week. That means that I have another edition of Viewer Question Friday. So, the question that I'm going to answer this week is all about what do I do when I have short term or intermediate savings goals, say between 1 year out to up to 10 years? Maybe I'm saving for a house, I'm planning to get married. I have these goals, and how much money should I risk? Depending on how many years out from a savings goal I'm at. I love this question. I'm going to answer it in a lot of different ways. But first, I just want to comment. I got a ton of great questions after last week's video, and I'm going to continue to try to answer one a week because I think that makes it easier for me to one come up with a title and makes it easier for probably people to find a specific topic that they're looking for. But I do want to acknowledge all the questions I'm getting because I'm going to answer all of them. It might just be that it's another week or so before I get to each question. And if I have too much of a backlog, I'll probably just answer multiple questions in a video. So the question we'll cover is, where should I save or invest for an uncertain-ish 5-year time horizon? I'm 29 years old. I'm hoping to get married, also buy a house in the next 4 to 7 years, and then also have kids. So those are all awesome goals. I'll hopefully need money for a wedding and a down payment. I have quite a bit of money invested in VTI and VXUS, so that's great. You're investing worldwide. You're a diversified investor. And I have 6 months of my expenses in an emergency fund and I bond. Okay, so I love the question about how do you allocate money towards savings that aren't retirement, but are kind of intermediate times between, say, 5 to 10 years. There's always a push and pull with investing. Is I want to take risks so I can earn more interest on my money. But at the same time, I also don't want to take risks because if the thing goes badly, then I'm not going to have the money that I need when I need it. And so how do you balance those things? A lot of times financial advice is going to focus on how do I plan for retirement? And it's actually, in my opinion, almost an easier thing, especially when you're younger, because retirement is so far away that you don't have to really think much about your asset allocation necessarily because you have so much time. And so if you are able bodied and you're in a career path or you have a job and you're going to be able to keep that up for the next 30 or 40 years, it makes it easier, not easy. I mean, it's still a challenge to weather declines in the stock market because you have so much time to recover. And so time is really your ally. Now, when you have intermediate goals where maybe you do have you're saving towards a house that you want to buy in 5 years or you want to get married, it becomes a little bit harder because the question is how much risk are you able to take knowing that you need a certain amount of money by, say, 5 years. And so I'm going to steal a concept that you may have heard of before called a glide path. And what a glide path is when you're talking about it for retirement, is you start at a very high stock or equity allocation early on in your career. And then as you get closer and closer to retirement, you start de-risking your portfolio. So you may start becoming less invested in equities, switching over to bonds or some other type of fixed income that is safer. And so if you look at most target date retirement funds, and so you may have heard of TDFs, that's where you can buy one fund and a fund manager basically manages this glide path for you throughout your investing career and closer to retirement. What they'll do is they'll start you at 100% equity allocation or maybe 90%. Vanguard does 90. I think that's too low to start. I think this is just my opinion, 30 or 40 years out from retirement, you should be as aggressive as you can personally manage because you have so much time. Time is your friend or your ally. But what's going to happen is that as you get closer to retirement, that glide path is going to come down and down and down, and it's going to switch more into bonds and other fixed income. In fact, most target date retirement funds and fund managers will be targeting a 60% equity mix with 40% bonds or 50% equity mix and 50% bonds as you get into your retirement. Now there's arguments for having a higher equity allocation in retirement. That's a whole other video. I'm more of the mind that you should be closer to a 75 to 80% equity allocation with 20% bonds, or at least for me, that's what I'm focused on just based on my personal situation. But anyways, the important part to answer this question is this idea of a glide path. And so you can imagine just visually, like if somebody's parachuting and they have their parachute, they're gliding down into the ground to have this soft landing. That's kind of what you're trying to do. Now, the challenge with a glide path for an intermediate goal that you have is you're not gliding down into a fixed percentage of equities and bonds that are going to sustain you through a 30-year retirement. you're gliding into, I need this amount of money on this date for my goal. And so there's not as much play with the idea that you are heavy in equities for goals like this. So let me actually share my screen and I'll use an article by Larry Swedroe. It's funny. One of my favorite financial writers, and I've never actually had to say his name out loud. But he has this incredible article, and it's a set of three articles back from all the way back in 2014. And I'll actually use his three articles as the basis for a lot of what I talk about with risk in my third investing video. But he has this focus on three ways to think about risk. One is your willingness to take risk, and this is really all around your personal makeup and how risk averse as a person you are. And this can be something that's really hard to know about yourself. So that's one way to kind of start thinking about how you tailor your portfolio. The other way is how much risk or do you have the ability to take? And that's where we're going to talk about these intermediate goals. And he actually has this table here, and I'm going to use this as a rule of thumb when I get into answering this question more. He talks a little bit about how much do you put into the stock market based on how many years before you need to actually receive the money. And so he points out if you have a 4-year goal, you should only be 10% into equities. And then as you go farther and farther, you can increase your equity allocation. And then really the last risk to think about is your need to take risk. So this comes down to how much do you need to earn on your investment for you to be successful? Because maybe you have a really high salary and you're able to save, I don't know, I'm making this up, $10,000 a month or something. Then if you have a $20,000 goal and that, hey, in 2 months, I'm going to be able to hit my savings goal, your need to take risk on earning interest on that money is lower. On the other hand, maybe you don't make a lot of money and you have this goal that requires that you earn at least 7% on average over time. That's really when you get into retirement planning is people can't afford to not take risk because they need that compounding effect of their money over time to get them to the goal that they have in retirement. So the question is, how do I invest my money in these intermediate goals? And so that's what I'm going to try to answer here. Okay, so the first thing I'm going to do for this question is just have all of your goals separate. So separate the different goals so that it's not all just compressed into like I have this 5-year list of multiple goals. I think the first one was marriage, and the next thing was home, and then the next thing was kids. Okay. So you might have this marriage be, let's say, a 4-year goal, and this home be a 6-year goal, and then this other goal for kids to be a 7-year goal. All right. And then you want to be specific about how much do you actually need. Okay, so for marriage, you have to decide how much are you going to spend. So when I think of marriage, I'm assuming that you're talking about funding a wedding. And so let's just say I'm going to go with a non-money monk amount of money. So let's say you're going to spend $30,000. That's not what we spent on ours. It was much less than that. But let's say you wanted to go big on your marriage. So I'll leave it at that. So let's say for your home, I think the median home income or amounts these days are around $400,000, maybe a little less. But let's just say you have a $400,000 home for your first home, and you want to save 20%. That means you would need $80,000 for a home. And I'm gonna change these numbers later, so don't get fixated on how much money we're talking about here. And then the other one is kids, and I don't know, I don't have kids, so I don't know what you might be planning for, maybe diapers and different things, or maybe you're talking about saving for college farther out. But let's say this is another $20,000 that you want to save for first year expenses of having children and all of that. Okay. So in total, what do you have? You have $130,000 here. So this is how much cash you need. Let's talk about saving. So now we're getting more specific about marriage. So that 30,000 over 4 years is 7,500 a year, or $625 a month. The other one, the home, 80,000. That's 13,000. That's a big one a year, or $2,222 a month. And then kids, it's easier. Kids are $2,857 a year or $408 a month since you're giving yourself 7 years. So what you can think about with these amounts are, one, are you able to save this amount of money every month to hit these numbers? And let's say you're not. Here's how I would start thinking about this. It's going to be a more effective use of your time. In my opinion, have more success being more specific about these top end numbers up here and how it equates to how much you have to save every month in real tangible goals that you can then strategically make decisions, especially around budgeting of am I able to do this? This example of $2,222 a month for a home. Well, you might say, well, I'm only able to save $500 a month for everything. So I'll never own a house. Well, that's where I would go back and I would say, well, maybe you don't put 20% down. Maybe you focus on 10% down. Or maybe instead of the median home price, you search for a home that's $300,000. Maybe it's not everything that you want in a starter home, but again, you're able to kind of get the amount lower there. Or maybe you're like me, I bought a house hack. And so for me, house hacking is basically the idea that you might be able to rent part of your house to subsidize part of the payment. And so you can search for homes that have accessory dwelling units. So those are homes that have like little studios on them. You could rent those out. You could buy a duplex. So then you're renting out one unit and you're living in the other. There's a lot of ways to kind of get creative with how much money do you need for each of these. Same thing with the marriage. Maybe instead of $30,000, you wanted to do an elopement. You want to go somewhere really nice and you spend $10,000. So now you've cut down the amount that you need to save basically in half from 625 to 315. And then let's say maybe this you've cut down to $1,000 a month. Well, what if a goal is out of reach? Even after I've done this and I've kind of narrowed it down and I've figured out really intentionally what it is exactly and how much I need at exactly what time, you could do a few things. So that's where I'm going to get into number four. What do I want to call it? So we'll call it, well, I was just going to call it flexibility because that's exactly what it is. So think about it this way. So, how much do you exactly need? Let's say you talked about marriage and you landed at, instead of $30,000, I want $15,000. So let's say you gave yourself a plus or minus 20% on the spend, okay? So on the spend, what that would mean is that 20% higher, you'd be willing to spend as much as $18,000 on this wedding, or let's say you were okay with spending less down to about $12,000. So you give yourself a little bit of flex in how much money you need. I think 20% flex is pretty good. You might even want to do 30%. This is dollar flexibility. And then let's call this time flexibility. And time, again, is going to be one of your biggest allies. So let's say that for this first goal of marriage, maybe instead of 4 years, you're willing to get married in 6 years. I don't love this example for marriage because I don't think money should really be the determining factor on when you get married. I think that's much deeper beyond money. And I don't think you need a lot of money to get married, frankly. So let's just use the home instead. So let's forget about the marriage for this. Let's just say for your home. So you want to buy a home in 6 years, but you would be okay renting for up to 8 years. So you add 2 years to your home. So you say, I'll either have it in 6 years or 8 years, and I would be okay as little as 4 years if I were to save more. But you start adding these boundaries around how much you're willing to flex the amount that you have and the time. The principle here is that the more you can be flexible and the more flex that you have in your goals when it comes to how much you need and when you need it, the more risk that you can take. And so this shows up in all sorts of ways. And it's actually a pretty cool lesson. I didn't realize it quite as much until I kind of reached the early retirement stage. But it's certainly in retirement planning, what you'll hear is something called variable portfolio withdrawal, where you vary how much money you take out of your portfolio based on what's happening in the market. And that overcomes all sorts of risks that plague retirees, because if you're in a down market and you stick to like the 4% rule, you can really damage your account, especially in the early years as you're pulling money out. But if you take this flexibility idea and you say, well, I can live on 2%. I don't have a lot of fixed costs and I can vary how much I need. It opens the doors to like all sorts of other things that you can do with your planning and how you allocate your investments. And I really like this because it's also a mindset thing. And I think that's something that shows up in life outside of just money is you want to be flexible and adaptable to the environment that you're in. Okay, so let's tie in one other concept here, and that is the maximum loss in an investment. And this is an kind of an ugly rule of thumb. And there's more to it than this, because what I'm going to talk about here is the idea that a stock investment could lose 50% in any given year, 50% loss in stock. The reason that it's kind of ugly is because, well, what about multi-year declines? The Great Depression, you went down 70 or 80%. The great financial collapse in 2008. I'm doing this from memory. I want to say it was 60 to 70%. So this might not capture all of it, but for me, it's a good enough rule of thumb to kind of help with how I think about doing this. So if you think about 50% loss, so let's say you have $10,000 and the stock market crashes. That means that the $10,000 you have could become $5,000. Now, that's at 100% of an equity investment. So, how do investors de-risk a portfolio is they remove money off the table that could be stand to lose. So let's say, well, I'm not willing to lose half of my money because I have a short-term goal where I need it to be ready at a certain point. The question is, well, how much money are you willing to risk in loss? Well, so let's say you went to a 50% equity mix, equity and a 50% cash. And I'm going to say SGov because SGov is a good ETF for a decent interest rate on your cash. That's a whole other problem, is that in a falling interest rate environment, we could get back to a place where your cash isn't earning you a lot in interest. I mean, we've all been accustomed in these last few years a 4% interest rate, 5% interest rate, but that's going to go down. That's at least what the government's pushing for right now is lowering interest rates, which will ultimately decrease the money that you're earning on risk-free assets. But anyways, so let's say you're at a 50% equity loss. What that means is that this $10,000, it 5,000 is in equity, and then 5,000 is, let's just say, in SGov, which again is just really like a treasury bill ETF. So this $5,000 is what could lose 50% of its value now. So this could go to 2,500, and this stays the same because it's basically risk free. So in a 50% equity, 50% SGov mix, what you are actually risking is 25% maximum loss, or 7,500 when you add these things together. So what I like to think about is that this amount, let's go back to the wedding example. I'm building flexibility into my wedding plan, and if the worst thing happens, how close is this to the flexibility I've built into my spending plan? Keep in mind, the thing with planning for me, it's not that I'm a total doomer and the worst thing can always happen, but you want to care for the worst case situation so that you don't find yourself in a place where you're in a bad spot and your plan fails you. You could have a sunny day scenario where, like in this example with 50% equity, you see a large appreciation, and now instead of $7,500 you actually end up with 13 or $14,000, and that's great. So now you have excess money for your goal that you could put into other goals. So you're trying to care for both sides of it. Risk is really just the idea that whether it goes up or down, it's different than what you were predicting. So that's loss. Now let's talk about time. So time, going back to the home example, we said 6 years, but you were willing to maybe wait 8 years. Well, then you're adding more time for a market to recover. Again, just as a rule of thumb, let's say it takes 4 years for a market to recover, and you're 2 years into saving for your home, and everything goes wrong, and it takes 4 years to recover. That goes into this 8 year idea, is that if you're giving yourself more time, it allows you to take more risk with the hope. And I use the word hope very specifically because we don't know the future, but with the hope that based on what we've seen in the past, that markets do recover over 4 to 5 years. Again, that's not a guarantee, but that's why you get paid for taking the risk. And so I'll use the opposite example of, let's say you had very inflexible goals. Like, what's that movie with Adam Sandler and Uncut Gems? I really like that movie. I haven't seen it in a while though, but I think he's under time pressure to come up with money, and so he has to do these really risky things. So if you are in debt to the mob and if you don't come up with $5,000 in the next 2 years, you don't really want to mess with flexibility or time, because I don't think the mob is going to understand that, well, the stock market's down right now, but it's going to recover in a couple years. They're just going to want their money. So you have to ask yourself, how much maximum loss and how much, maybe I'll call it time loss, are you willing to take on each of these goals? And so that's basically how you would start thinking about coming up with an allocation. I would go back to this on the other side here, and looking at my screen. Sorry, this is really chicken scratch, but how much you need and the saving part of it, it's easier to figure out saving and expense management than having to go through and kind of do the really hard work of depending on investment performance to really carry you. And so often the easiest path to hitting intermediate goals is going to be getting really intentional about what your 1 to 2 to 5 year goals are, and then reallocating expense management to those goals versus really relying on short-term market fluctuations to carry you one way or the other. Really, the unfortunate truth is that for a lot of, especially short-term intermediate goals, it really is going to be carried by how much money you're able to save towards that goal based on your work and saving directly from your labor versus the compounding effects that happen over time when you're talking about fire or financial independence, retiring early, or long-term retirement planning. So that's where I would spend the bulk of my energy. But going back to this, what we start to see is this framework where, okay, I can change my equity allocation based on how much risk I'm willing to take and how much flexibility I'm building into my goals. Okay, so going back to Larry's kinds of rules of thumb as you think about your investment horizon, which is how long you're going to be saving money for and when do you need something, and tying that to your equity allocation. Let's go to this example where we talk about 6 years at a 30% equity allocation. Well, like for the home, I'm going to use that because that's the example I was talking about earlier. You gave yourself a +or- 2 years. So what you could say is that I'm kind of more comfortable in this range one way or the other, knowing that I might have to wait longer. So maybe I'm willing to take more risk out to here. If you want to care for the longest time period, you could say, well, I'm okay out to 8 years, and so then I'll start at a 50% VTI mix, and then maybe a 50% SGov mix because that's my goal. Or you could even go more aggressive. You could say I'm willing to do +or- 2 years, and I'm willing to even swing as much as 25% of my goal. And so what that might mean is that you're taking or increasing your maximum allowable loss up a little bit. So maybe then you're into more of like a 60-40 mix. Again, accepting and understanding the risk that 10% shift from cash to equities means that I increase my maximum allowable loss. So then that could just be another way that if you wanted to be more aggressive, then you're into something like 60% VTI. But now again, that might be with a home, but if you're, let me change colors on my pen. If you're here at 4 years with marriage and you're time inflexible because it's a big priority and you're getting married and you're not going to allow money to stop you from doing what's important, you might not have the same time flexibility. So then you are starting with a base of like a 10% equity mix, and maybe you're flexible in the amount that you want to spend. Although I would say maybe you want to talk to your partner about that. I'm very frugal, so you could spend. I'm very happy to spend extremely small amounts of money, but your partner might have something else in mind, and so they might say, "No, you're not going to play with our $20,000 marriage fund, and we're going to have it funded and ready exactly in 4 years." Then really at that point you just want to be like 100% in SGov or another cash equivalent, and then you just want to use your sweat equity and your labor to make that happen, ensuring that it happens at the time that it does. And I'm just realizing now that on this screen you didn't see my other chicken scratch over here, but this is basically just showing if you add time flexibility and the amount of allowable loss that you're calculating into your plan, you could change the ratio of stocks to equity, sorry, stocks to bonds, or to a cash equivalent. The challenge I think with this is that, are you going to be disciplined enough to slowly tick your way down from the 9 year amount to 7 year to 6 year to 5 year, slowly rebalancing by selling stocks and going farther into cash as you get closer to year zero? That takes a lot of discipline. And not only does it take discipline, but because these are all intermediate term goals, you're going to be doing this in a brokerage account. You'll be having some type of tax event happen. You might be selling at a gain, or you might be selling at a loss, which lets you help offset your taxes. So you could do it either way. But I think the challenge when you go into setting up a glide path for these intermediate term goals is that you do want to de-risk your investment as you get closer to your goal, and that can be emotionally difficult to do for one reason or the other. Okay, so a few other comments on how you might accomplish this. I haven't tried this feature, and at some point I might do a product review of Betterment. Betterment has been impressing me the more and more I read about them. I believe that Betterment does intermediate term goal setting and allocations, and so that could be a really cool value add for a robo advisor, getting into this idea that you have to constantly rebalance. I believe, and again, I could be wrong, but I believe what Betterment does is it has you set your time horizon, and then it will recommend an equity to cash position, and then it's going to rebalance over time, getting closer to cash as your time horizon gets closer. That could be a cool way to do it, because then you don't have to do anything yourself. And so you just kind of set it and forget it. And I might have a video out on that. Other ideas, you could look at dividends. There's all these videos out there on both sides of the camp. I've talked about dividends in a previous video. I don't think about them as just free income. But for this, if you wanted the idea of just investing and an asset is spitting back capital to you, that then you could take those dividends and put into cash, that would be probably another way of slowly rebalancing. And then you also get the emotional benefit of seeing a dividend come in, then you're seeing your asset kind of pay you back. But to be fair, a lot of dividends are actually going to be a lower interest rate than you might get on cash right now, but that could be changing. So dividends are another thing that you could consider, as is interest on cash, or dividends or interest payments on bonds that you hold. One other idea, and I'm coming back and adding this later in the video that I neglected to mention, is you could look at something called duration matching with bonds. And so the idea is that you are purchasing fixed income assets that mature when you need them. So in the example, we're looking at a home, you could build a 6 year CD ladder, or I'll show you on a website, you could build a TIPS ladder. TIPS are Treasury Inflation Protected Securities. They're from the US government. And they are going to adjust how much interest they pay based on unexpected inflation. So this would be another way that you could create a ladder of TIPS that meet the goal when you need the money. The challenge, and the reason I didn't really think about bringing up duration matching and building a ladder, is that traditionally you will already have the money as you're building the ladder. But there's no reason that you couldn't do it for an intermediate goal. And I'll show you that here just quickly. So here I am on tipsladder.com. I really like this website. I don't know the owner, but it's a cool thing that they put together for free. The few things I want to call out. So when you look at building a ladder, you pick out your first year to be funded and the last year to be funded. You could say something like, I'm going to start this ladder in 2026. I want it to end by 2031. And this focus is really on providing some level of income. But for this would be more like, hey, I want a certain amount of money by the time that this expires. But what you can see is that when I scroll down under funded years here, is you have the different tips that you would purchase, similar to how you might buy a treasury bill. These are the IDs of the tips. This is how much it would cost you. And then this is how much income it would produce in total for a given year. The nice thing about this is that this is 100% risk free. The interest that it's going to accumulate is guaranteed by the US government. And any adjustments in unexpected inflation just mean that you're going to earn a higher interest rate. But what this would show is that, hey, if you put in $59,000 now, by the end of this 6 year period, you would have a total amount earned of $61,307. So, what the idea of duration matching is you're finding a fixed income asset that matures when you need it. So, this would be a great way of doing it. The challenge is that this really is going to look at the purchasing cost for today, which if you are younger, you're most likely earning money as you work and then saving a little bit more. So you're not able to make a $60,000 purchase of a tips ladder right now. But if you do find yourself with an excess of cash and you're looking at what's a risk-free way for me to invest my money for an intermediate term goal, I don't want to take equity risk and I want it to be at the right amount at the right time. And so that's duration matching really with fixed income. And you can do that with CDs. I like tips for someone that doesn't want to take any risk. And there's nothing wrong with that, depending on how much flexibility you have in setting up that goal. So I hope that long answer has been helpful. There's actually a lot of financial theory that goes into the idea of how do you set up an allocation based on a goal. So we covered a lot. We covered the idea of a glide path, which is something that you will learn about whether you're doing intermediate term goals or you're working on retirement planning. We talked about flexibility and how much risk you actually need to take and you're willing to take. And I think the larger emphasis that I would put on intermediate term goals and how I was successful with my most of my intermediate term goals was not because I had a lot of profit off of investing, but it was because I was really intentional about what it is that I want when I need the money and when do I need it by, that allowed me to allocate money I had coming in to those goals. I think that the allocation to stocks is a really good idea and understanding that is important, but I think the behavioral element of managing cash flow is going to be probably the 80/20 in this whole thing. So you're probably familiar with 80/20, but in my mind, what I think about is like what causes the 80% of the output for 20% of the effort or focus. The focus that you're going to want to put in is to managing cash flow for your intermediate term goals and then really negotiating how much you actually need to be successful with those goals before you even get into investing. So I hope that the balance of focusing on cash flow and how to invest for intermediate term goals has been helpful. We went through a lot of stuff. So if you have questions, feel free to leave it in the comments. I'm always interested to hear how other people think about and do it. And yeah, so I hope you have a good weekend and I'll see you next week for another Viewer Question Friday.